Hey everyone, welcome back to our US to Gold Roundtable. With me as always, Peter Grant and George Cooper. Thank you guys for being here. Today we're going to discuss what has again come into the news is the idea or fear of deflation. But instead of talking specifically about deflation, we're going to talk about kind of what we call inflation or bust, which is where we really feel the Federal Reserve and our government are going to take us, that they're going to try to do inflation at all costs. And kind of going to touch on the James Bullard article, the head of the St. Louis Federal Reserve, who came out and basically made a direct recommendation to the Federal Reserve that we implement quantitative easing a la England, where we buy directly U.S. Treasuries rather than what we've done in the past, which is more mortgage-backed securities through Fannie and Freddie. We're going to get into all of that. Pete, talk to us a little bit about why the buying of mortgage-backed securities through quantitative easing really didn't have the economic impact that it needed to.
Well, I mean, it certainly had a positive economic impact on the banks, and it allowed them to offload a fair amount of underperforming assets from their balance sheets to the Fed's balance sheet. But in terms of a direct impact on the economy, I think that the impact was very limited. It doesn't put a lot of money back into other people's pockets, into the consumers' pockets. Though it's become increasingly hard for many people to refinance their mortgages to take advantage of that in the first place. So right. When you see 30-year fixed rates dropping to all-time lows, certainly there have been a lot of people that have been able to refinance and so forth, but I think that that's water under the bridge at this point.
Most people already have.
They've already done that.
Right.
The difference between a 5% mortgage versus a 4.5% mortgage, it's quite honestly, it's not worth refinancing at this point. And people who are buying new homes, first-time buyers, because of the perceived risk, they're not able to take advantage of those rates anyways in large numbers. So again, in buying mortgage-backed securities as a form of quantitative easing, it more benefited the banks than individuals. But it's become abundantly clear, and it was backed up by data this week, that personal consumption expenditures are down, income is down, the savings rate is up. And it just goes to show that people are hunkering down for bad times ahead. The savings rate is up to 6.4%.
Yeah.
So it's up that way in 30 years, right?
I know.
And even the people that saved the money through these mortgage refinances are actually saving the money.
That's exactly it.
Yeah.
They're paying down debt, or they're putting it in the bank, socking it away in anticipation of.
But to kind of build on this, what's really happening is it's a lot more of these kind of creative maneuverings to try to help the housing industry, but all it's really doing, as we've said many times, is kicking the can farther down the road. And so, but this gets us kind of to where we can build on this Bullard article. 7 Faces of the Peril is what he entitled it, and he talks about the different. There's basically 2 different, what he calls basic states, stable states within the interest rate economy, where you have a low inflation rate and an interest rate that you basically apply. And so there's a rate where you have a little bit higher inflation rate and a little bit higher interest rate, and that's considered the most positive stable state within an economy because you have a certain level of growth. But you can actually flow back into a very low stable rate where you have, and this is the deflationary economy that Japan is stuck in, where you have a really low interest rate and you have a really low inflation rate. And that's kind of what we're struggling with here, is that we've promised this long-term, really low interest rate, and it's created this paradigm of people feeling that they can rely on that in perpetuity. So there's no action based from that. And that's kind of what Bullard is saying, is he's saying that this ad nauseum low interest rate is actually bad for the economy. That you need to actually have the threat of raising interest rates or the threat of inflation for things to actually be moving.
And that's exactly the way things unfolded in Japan in the early 90s, and now it's referred to as the lost decade. But here is Japan now entering its 3rd lost decade because of this policy. And yet, with our eyes open, we are continuing down that very path.
But this is the inflation or bust concept, is that you look at what's going on out there and you say, what is the most likely path? And yeah, we've said this before, that the Federal Reserve exists to protect the banking system. That is why they are there. Now, deflation is not good for the banking system.
No, and that's a point that James Rickards made on CNBC this week, that the whole point of the Fed basically is to protect the banking system, and And deflation obviously occurs in a bad economic environment. So the default rate on loans and so forth skyrockets during deflation, and it is devastating to the banks. And so it is in the bank's best interest, and therefore in the Fed's best interest, to create inflation, no matter what it costs. And that has always been Chairman Bernanke's position. I mean, he is, well, it goes back to that very statement where he very adamantly said that the government possesses a technology known as the printing press, or the digital equivalent, to print essentially endless amounts of money at no cost. The one thing that I take exception to is the no cost, because obviously it does come at a cost.
Right.
It devalues the dollar, and in the long run, it can have substantial costs.
It's wonderful the way this conversation has kind of evolved around these topics, because then now you can bring gold into this conversation. You can say, well, how do all of these things affect gold? And then, so you say, okay, inflation or bust. So let's say they are successful in causing inflation. I mean, you've got the #1 argument for a bull gold market, period. But let's say they aren't successful, but they do continue quantitative easing, they do continue printing money. Well, what's the net effect of that? You have a massive erosion of people's confidence, both in the solvency of the government, but in the stability of the currency, which leads to gold ownership. Now, maybe gold doesn't go up in terms of the dollar as much, but it holds certainly better value in the world economy than the dollar will.
Yeah, I think, and Japan, again, is the classic example of this, where, if their policies are unsuccessful in creating inflation and you get sucked into decades of stagnant economy, it creates erosion of wealth in other areas, certainly in terms of real estate and the traditional asset classes and so forth. Basically, we look back at the Dow and we say, well, here we are in the Dow 10 years, basically at the same level with no gain. And so that's the big concern. It becomes, where do you put your money? And particularly if you're wealth preservation minded rather than income minded, gold is the perfect solution for that, even in a deflationary environment. And you look back to the 1930s, the last time we had a protracted period of deflation, and gold performed extraordinarily well.
Well, and that's what I don't understand about these deflationists, is you've got, Prechter and Bill Gross and
Denninger.
A litany of them, and all of them say that the best way to protect yourself against deflation is cash. Cash is king in deflation. But the part of that just never equated with me.
If they allow it to happen.
Well, exactly, is if they allow it to happen, A, and what they will do to try to prevent it from happening, B. So even if they are unsuccessful in the methodology that they choose to try to prevent it, those methods undermine the confidence in the value of the currency. I just don't understand. It doesn't equate to me that just residing in currency in that scenario in the modern economy makes sense.
Well, I think let's look at the track record of people who have been successful, and John Paulson is one who comes to mind. And he is actually betting on inflation. He believes that, as you said, Pete, this elephant's going to come bursting into the room, and it's just a question of when. So he's very bullish on gold. There's another analyst by the name of Ian Gordon, who's from Canada. He's been kicking around for many years. He's probably in his late 60s, early 70s. And he's actually looking for the Dow to go down and gold to go up. And he says eventually that the Dow is going to be down, say around 4,000, the gold's going to be 4,000. Very much like Richard Russell, who's been saying the Dow-gold ratio will be 1-to-1 when it's all said and done, precisely because people will lose confidence in paper, will lose confidence in the stock market as a way of protecting themselves against devaluation, and they're going to move into gold. And there just isn't enough gold to satisfy the demand currently. So
we've got a big Fed meeting next week?
FOMC
next week. So, we'll look to that to see what happens. Perhaps we'll get some conversations about this quantitative easing. It'd be really interesting to see, because if they do announce such a thing, I think you're going to see, gold and probably the stock market at the same time behave accordingly, with probably both headed higher, which is typical of an expectation of inflation or an attempt at it.
Right.
So we'll look to that. We'll see what happens. But this is a great conversation, guys. Thank you very much. I'm Jonathan Kosares.
I'm Peter Grant.
I'm George Cooper.
Stay in touch with your broker.